Hi everyone, welcome back to our channel. I'm Chelsea Kennedy, the Executive Practice Coordinator here at Butler Wills and Estates. Today's video is about preparing an executor's accounting, what's involved, and what to do if money is missing. We touched on the subject in our video about estate releases, and this video will go into more detail. We're going to cover what an executor's accounting is, why an executor needs to prepare one, which documents make up the accounting, and what to do if money is missing from the estate. We'll also provide you with some resources for putting together an accounting. Let's get started with just what exactly an executor's accounting is. An executor's accounting is a package of documents that the executor provides to the beneficiaries when it's time to distribute some or all of the estate. More complex estates frequently have multiple accountings along the way, since the executor is more likely to do a partial distribution. The basis of the accounting is developed using the executor's record-keeping ledger. There are three main documents included in the accounting. Each of these documents plays a role in bringing the estate to a close. When these documents are put together, they explain the transactions in the estate. There are several reasons an executor should make an accounting. The executor is legally responsible for everything that happens in the estate, so keeping thorough records is only good sense. Since the executor can also be held personally responsible for any losses to the estate, keeping records also protects the executor from possible liability. As we discussed in our video about releases, the executor provides the residual beneficiaries with the information they need to be able to understand what has happened in the estate. This is important because their share of the estate is directly impacted by the executor's actions. When the time comes to file the final tax return, if the executor has an accounting, he or she will have all of the information needed to complete the return. This includes any money claimed as income and deductions. In the event that an executor needs to pass his or her accounts in front of a judge, the bulk of the work will already be done. Usually passing the accounts is only needed if the beneficiaries won't sign the releases, but the process can also be useful for complex estates. There are three documents that make up an executor's accounting: the statement of receipts and disbursements, which shows the amounts coming in and going out of the estate; the statement of proposed executor's compensation, which shows how much the executor will take as payment; and the statement of proposed distribution, which shows exactly how much each beneficiary will receive. Let's look at each of these documents in more detail. The easiest way to prepare and present the statement of receipts and disbursements is in the form of a table or a spreadsheet that provides columns for numbers. It should begin with the first transaction after the death of the deceased. It is a good idea to number the entries so that if the beneficiaries have questions about a particular transaction, they can easily refer to the number. Chronological order is the most logical because you can create your statement of receipts and disbursements most easily by converting your ledger of transactions. The more information you include, the fewer calls and emails from upset beneficiaries you can expect. Whenever you have a bill that is made up of components, break down the components separately. Usually, that just means the price, which is one component, and HST, which is a separate component. In other cases, there could be more components. If any money is paid to beneficiaries, be very clear as to why it's being paid. For example, reimbursement for expenses should be clearly separated from payment of inheritance. Having a running balance isn't particularly helpful or relevant when providing your accounting, so it has been omitted. However, you can quickly and easily check your math by totaling up the receipts column, then totaling up the expenses column. The difference between them must be the amount of money you actually have available in the estate. The statement of proposed executor's compensation is divided into three short sections. In the first section, you'll show your calculation for the fee portion of your compensation. If the will states that you are to receive a certain amount of compensation, you may claim that as your fee, but you may not claim a larger fee. Even if the general law would have allowed you a larger fee, you may not claim a higher amount than what the will states. If a fee is not stated in the will, an executor can claim between 1% and 5% of the gross value of the estate. The second section of the document allows you to claim reimbursement for your out-of-pocket expenses. You may also claim mileage if you drove your car to take care of estate business. There is no specific amount stated in the law for mileage. A good suggestion is to find out how much the provincial or local government pays employees for mileage and use that as your figure. The third and final section of the document shows the total fee and the total expenses added together to make up your claimed amount. This statement uses figures from the Statement of Receipts and Disbursements and the proposed executor's compensation and ties the whole accounting together. This statement is basically one long math equation. We start with what we know is in the estate, hold some money aside, and end up with the money that can be paid out to the beneficiaries. You're keeping these funds, called holdbacks, just in case they're needed. If they aren't needed, they'll be paid out to the beneficiaries at a later date. Common holdbacks include possible tax or legal fees and the amount claimed on the proposed executor's compensation. All of these holdbacks are subtracted from the amount in the estate. Once you've subtracted the holdbacks, you have a new number that represents the money that you are going to pay out to the beneficiaries. This is where you refer to the will, or the law of intestacy, to figure out exactly what each person is going to receive. List each beneficiary down the left-hand side of the form. Include the description of how you arrived at their amount, such as 50% of the value of the estate. Then, across from each name, put the dollar amount each person will receive. When you calculate the dollar amount, make sure you're working with the number that is listed next to net amount then available for distribution. Since numbers do not always divide evenly, you may find that you have a penny or two left over. It doesn't matter which of the beneficiaries receives it, so you may add it randomly to any one of them. Most likely, you want the amount left in the estate to be zero, not counting the holdbacks. As we previously mentioned, the executor can be held personally liable for any amounts missing from the estate or for having caused any losses to the estate. When someone passes away, their estate becomes a trust. The executor is a fiduciary of this trust, meaning he or she must prioritize the estate's best interests over his or her own. If the executor does something to cause the estate to sustain a loss, whether by accident or on purpose, this is a breach of the fiduciary duty. The courts take this matter very seriously. What happens when money is missing depends in part on how much money is missing, and in part on how the executor handles the issue. Most people don't act as an executor more than once in their lives, and it's a steep learning curve. Because of this, most losses to estates are caused by honest mistakes. For example, there may be a deadline to apply for a government benefit that the executor missed, or an extra charge that the executor wasn't aware of. In these situations, the executor should be honest about what happened. Trying to hide the mistake is never a good idea, as the beneficiaries will find out and assume the executor is hiding more errors. Sometimes, money is missing due to theft by the executor. This happens when the executor takes money for his or her personal benefit or lends estate money to someone who isn't able to repay it. Keep in mind that this situation is different than an executor advancing funds to a beneficiary. When money is missing from the estate and cannot be replaced, what happens depends to some extent on how much money is missing. The executor may be able to pay back the missing amount. In cases where this isn't possible, the executor could face criminal charges. At this point, the executor would need a criminal lawyer rather than an estate lawyer. We've put together a few resources to help you deal with making an executor's accounting. We've got do-it-yourself guides and kits, which are available in our office and online. Each of these kits include instructions for preparing each document involved in the accounting, example and completed sample documents, templates that you can use for preparing your own accounting, and tips for completing each document. You can also contact our office to schedule a one-time consultation to have your accounts reviewed, and there's no obligation to hire us for further work. Where to find us. Visit our website at butlerwillsandestates.com or send an email to me directly at chelsea@butlerwillsandestates.com or give us a call at 709-221-5511. If you like this video, make sure to click the like button, and if you want to see more videos about a variety of estate law topics, make sure to click that subscribe button. Thanks for watching, and we'll see you at our next video.